but John and Jane Doe are enough of a beneficiary and have enough control that they're the ones who are paying the taxes. And at the end of the line, that's really what we're talking about. Hi, this is Jeff Mersace, the Plain English Attorney, and today I've got an interesting topic, and this whole topic is designed to help a specific client. I'd give a shout out, but there's that whole attorney-client privilege thing. So let's kind of get into it, and we're going to talk about EINs or tax ID numbers and trusts. When do you need it, and for what kinds of trusts do you actually need it? All right, so for trusts, this is just a story that happened to a client of mine. When you have a revocable living trust, you do not need a tax ID number for it. As long as that person is alive, it's their trust, they're the trustee, they're the beneficiary, they control everything. There's no need for a separate taxpayer ID number, and I stress this when I talk with my clients. However, she went down to the bank and ended up saying, yes, here's my funding spreadsheet. The attorney says that I need to put this account into the name of the trust. And he goes, oh, well, you need a tax ID number. Well, he said he didn't. No, you do. And he went online and got a taxpayer ID number for her trust. Now, for the next 4 years, she had to pay her accountant extra because he had to communicate with the IRS when they'd send these threatening notifications. You need to file a 1041 tax return because you have this irrevocable trust that might have income. It wasn't an irrevocable trust. So by getting her a taxpayer ID number, she lost a couple of $100 over the years because she had to have her accountant communicate with the federal government that a tax return was not required. So before we're going to end up getting a taxpayer ID number, there really should be a reason for it. So let's go ahead and talk about the first type of trust, which is the most basic one that we do for our estate planning clients. We do it all the time. And this is where we're going to define some of the terms. There's Trustor and Grantor. Now, these are actually two different things, but even attorneys end up using them interchangeably. They are very, very often the same thing, but not necessarily. All right. A trustor is the person who sets up the trust. It's their trust that they're putting together. The grantor is who is putting assets into the trust. Again, often it's the same person, but not always. All right, so the trustor sets it up. The grantor puts assets into the trust. And then there's a trustee. All right, the trustee is who's in charge of managing the trust, who has control over those assets and can make decisions regarding the trust, but they have to follow the terms of the trust. And then there's the beneficiary. When we're setting up these revocable living trusts as a way to handle estate planning, we do it so that the people who are setting up the trust, it's their estate plan, they are actually the first level beneficiaries because this trust is being managed for their care during their lifetime. So even if they become incapacitated and another trustee steps in, it's being administered for their benefit. that trustee is running the trust for them and on their behalf. And therefore, because of all of these factors, the trustor, grantor, trustee, beneficiary, the fact that it's for their benefit, even if another trustee is in control of it, they don't need to go and get a separate taxpayer ID number. It's still being run under the Social Security number of one of the couple, whoever the primary taxpayer is. Or we're not going to get into splitting them, because one thing, if you actually have a couple, you can use either taxpayer ID number. Sometimes either Social Security number, depending on the account. Sometimes we have clients who have separate checking accounts, separate investment accounts. There's no need, when they're putting each of these accounts into the trust, to come up with one taxpayer ID number. You can keep the Social Security number of the person putting their account into the trust, even if it's a joint trust, and you can keep the Social Security number of the other person putting their accounts in. It's all about who is responsible for paying the taxes. Now, if you're married filing jointly, it really doesn't make any difference. But if it's married filing separately, and more we're seeing that actually happen with some marriages, they're going to get, you don't want your spouse getting your 1099 or your K-1 to pay taxes on your assets. It's no. It keeps the Social Security number of the person who's responsible for the taxes. All right, this is an important point that will come up later. All right, so that with the Revocable Living Trust, you do not need a separate taxpayer ID number. Let's go all the way to the other extreme, where we have irrevocable family trusts. We use these a lot when it comes to Medicaid planning. The idea is you're taking assets, you're moving them into the trust. You want to completely step away. You're not retaining any rights to it. It's not for your benefit. You want these assets out. So it's as if you've gifted and transferred them and it's done. Now, when we set this up, it's usually a family member who's the first listed trustee. They're the ones who are actually the trustor. They're setting it up. All right, well, who's the grantor? It could be John Doe and Jane Doe. It could be, but not necessarily. This is a very versatile document depending on the strategy we're using to get assets in there. Just to show the Medicaid example, if John and Jane Doe want to take their stock account and move it into the Irrevocable Family Trust, that's a gift. So there's a 5-year look-back period on that gift, so that Medicaid will see that it was a gift going into the trust. Well, how do you avoid that? Well, let's just say there weren't a ton of capital gains and they just decided what we're going to do is we're going to liquidate the stock. And maybe John and Jane Doe don't have real estate. They don't have a primary residence. And here's this $300,000 account that they're trying to protect. But what they do is they have their son that has a $400,000 house, and they're going to buy 75% of it because they're allowed to have a primary residence. The son gets the $300,000 in that, quote, sale, and there's a contract and there's a sale. And then the son says, all right, what I'm going to do, because there's a right of survivorship, I know I'm probably going to outlive my parents, I'm going to get my house back, but I'm going to take this $300,000 and I'm going to put it into the Irrevocable Family Trust. There's no 5-year look-back period. John and Jane Doe have filtered it through something that's an excluded asset, but the money is still going in there. So in that case, the grantor would be the son, Jim Doe. All right, and who's the trustee? Jim Doe. Who's the beneficiary? Also Jim Doe. Well, wait a minute. This is, John and Jane Doe's money. That's how they're looking at it. Yeah. And they trusted Jim enough that if they need money, Jim's going to take it out of the trust, put it into one of his separate accounts, and then turn around and give the money back to the parents or pay for whatever it is. So that's how the irrevocable family trust works. Now, because of that, because John and Jane Doe aren't on this at all, it does need a separate taxpayer ID number. It does. And it's because of all of those factors, the trustor, the grantor, the trustee, the beneficiary, all of that is looked at. And because there's total control with Jim Doe's the beneficiary, Jim Doe is also the trustor setting up this trust. Yeah, it needs a separate taxpayer ID number. Now, what technically ends up happening each year, you look at the accounting and you have an accountant go through this. A 1041 needs to be filed because there's a separate taxpayer ID number. Remember that story we started with. We don't want to do a 1041 if we don't have to. Plus, the tax rates on a trust end up being much higher, much more quickly than an individual. So typically, Jim Doe's going to pay the taxes for any gains and pull whatever money out he needs to pay the additional tax. Because again, Jim Doe's allowed to take all the money out that he wants. All right. So the 1041 gets filed under the taxpayer ID number showing zero income with whatever the notes are. Again, it's zero net income because there might be 1099s and K1s and whatever, shifting that income over to Jim Doe. Now let's get to the point, and this is for the client that I was mentioning, where he's having an issue because he's the trustee. In this example, he's the Jim Doe, and his parents are John and Jane Doe, and this is an irrevocable property trust. All right. An irrevocable property trust is designed to put real estate and technically other highly appreciated assets that perhaps it's stock. We don't typically use it for stuff that's really is going to generate income, because I'll come to that in a minute. So, all right. So who is the trustor? Who's setting up this trust? Well, in this case, it's John and Jane Doe. They're setting this trust up. Who's the grantor? It's also John and Jane Doe. They're moving their real estate into this irrevocable property trust. We're not necessarily using this trust a lot and having them move the real estate into the trust when we need to do an emergency Medicaid planning, because there's that 5-year look-back period. Okay. And in this specific case, yeah, John and Jane Doe did move their real estate in, and they moved it in this particular case, like 8 years ago or more. So they're past that 5-year look-back period. So now, who is the trustee? Jim Doe. It's the son who is the trustee. So this transfer was made complete, but John and Jane Doe are the trustor, the grantor, and John and Jane Doe are also the first level beneficiary, but they're keeping just very specific rights. Well, why just some rights and not others? Okay. They're keeping the right to any income generated off this trust. They're keeping the responsibility for paying taxes on the assets in this trust. They are keeping the right to live in that property. They get to live there, And if they don't want anyone else living there, that's what happens. It's they get to live there. Well, do they get the right to sell the property? Well, no. Jim Doe has to do that. Oh, well, all right. Why do we set it up this way? Because we're talking about two different sets of rules. When you're talking about estate and gift taxes, we're talking about, was it a, quote, completed transfer for moving those assets in? Well, no, because they're retaining enough rights, the right to live in the property, the right to the income, and the responsibility for the taxes, that it's not a, quote, completed transfer for tax purposes. Well, wouldn't you want it to be? Well, no, because the real estate appreciation could be considerable. And if it's sold after John and Jane Doe have passed on, then they're getting what's called a capital gains stepped up basis. So the cost basis in that property ends up being the fair market value on the date of death. So that's why under that set of rules, we want it to be John and Jane Doe's enough. The other set of rules is Medicaid. Do they own that house enough that it's going to be an asset on the Medicaid balance sheet? No. Just retaining the right to live in the property and whatever income is generated and the responsibility for paying the taxes and stuff like that, that's not enough rights that Medicaid says, yes, it's yours and therefore you have to potentially do something with it or they can put a lien on it. So it's an intentionally defective grantor trust, which means you're straddling the line of different sets of rules. All right, so what should the EIN for this be? Well, this is the situation. You go to a bank and you're setting up an account. Well, the big question is, who's responsible for paying the taxes? That's something that John and Jane Doe kept with them under the terms of this trust. Well, wait a minute. It's an irrevocable trust and Jim Doe's the trustee. Yeah. But John and Jane Doe are enough of a beneficiary and have enough control that they're the ones who are paying the taxes. And at the end of the line, that's really what we're talking about. Who's responsible for paying the taxes? So the situation that's being set up here is the bank is insisting on getting a separate taxpayer ID number. And I don't want to get too deeply into this, but we did a transaction where another family member bought into that house as part of an overall Medicaid plan. And so the funds need to be deposited into this account in the name of the Irrevocable Property Trust, but then they're going to be moved out immediately. But I just know if you apply for a taxpayer ID number, there's a chance that the IRS may be bugging you for several years. Well, why haven't you filed your 1041 tax return? Because there's no income. And it just becomes a huge inconvenience when at the end of the line, who's responsible for paying the taxes anyway? It's John and Jane Doe. So it would be perfectly acceptable to use John and Jane Doe's Social Security number since they're the ones responsible for paying the taxes. That's what we have with an intentionally defective grantor trust. Now, I already know banks, well, our rule says. Okay, so you have to decide if it's worth the potential headache of having to explain to the IRS why there was no 1041 tax return filed, potentially for several years, or even like my other client, paying an accountant to do that just to have this banking transaction happen at that particular bank, Or do you just go and find another bank that's going to understand that because it's an intentionally defective grantor trust and John and Jane Doe are keeping the responsibility for paying the taxes and therefore it's okay to use the social security number? Well, all right. That's going to really be up to Jim Doe since he's the one that has to handle this transaction as the trustee, even though John and Jane Doe are the trustors, even though they're the grantors, even though they're the first level beneficiaries. Jim Doe is the one who's the trustee responsible for handling these things and therefore setting up that account. So that's the explanation around all of this. So, all right. So I hope that information is useful on these three trusts. Again, revocable trust, no EIN. Irrevocable family trust, well, yeah, because all of those factors, trustor, grantor, trustee, beneficiary, all of that is with Jim Doe in these scenarios. So yeah, there's a separate taxpayer ID number, but now we have that thing that's in the middle, this intentionally defective grantor trust, where the taxation and the beneficial enjoyment of the real estate and any income generated has to go to John and Jane Doe. It's just that Jim Doe is the trustee and is in charge of handling that asset on paper because it's a irrevocable trust. It doesn't need a separate taxpayer ID number because John and Jane Doe are responsible for the taxes. So again, I hope you found that information useful. As I always tell my clients, please stay safe, plan ahead, and enjoy life. And whatever you do, make it a great day.